Why silver fluctuates more than gold and gold pullback. Explained. Silver is moving. Gold is pulling back. And most people have absolutely no idea what that actually means for their money, for their business, for everything they've built. This is not a market update. This is not a trend report. This is a warning. And the question is not whether you should be watching this. The real question is, can you afford not to? Welcome to the boring currency, the one channel that tells you what the numbers are actually saying before everyone else figures it out. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't leave the house without your reading glasses, would you? Subscribe to this channel. It's the pair of glasses your financial vision has been missing. And one more thing, where in the world are you watching this from right now? Drop your city, your country, right there in the comments. Because what's happening in these markets affects every corner of this world. And we want to know exactly where our people are. Now, let's get into what no one is telling you. Every few months, the same question surfaces. Investors open their phones, they check the charts, and they see it again. Silver jumping 5% in a single day, while gold moves barely 1%. They scratch their heads. They ask the same question millions have asked before them. Why does silver behave so differently from gold? The answer is not simple, but it is important. And for anyone who takes their financial future seriously, understanding this difference could be one of the most valuable things they ever learn. Gold and silver sit next to each other on the periodic table. They are found in the same mines. They have been used as money for thousands of years, and yet they are not the same, not even close. Gold has one identity. It is a store of value. Governments hold it. Central banks trust it. When the world feels uncertain, money flows into gold like water finding its level. Gold does not care about factories. It does not care about electric vehicles or solar panels. It simply holds value, the way it has always held value. For centuries, silver is different. Silver lives two lives at once. On one side, it is a monetary metal. Like gold, it has been used as currency throughout history. People buy silver when they fear inflation. They hold it when they distrust paper money. In this way, silver and gold are brothers. But on the other side, silver is an industrial commodity. It is used in electronics. It is used in solar panels. It is used in electric vehicles, medical equipment, and semiconductors. More than 50% of all silver demand today comes not from investors, but from industry. This dual identity is precisely why silver fluctuates more than gold. When the economy is booming, industries consume more silver, prices rise. When the economy slows down, industrial demand drops, prices fall. Silver responds to two worlds simultaneously, the financial world and the physical world. And when both worlds pull in different directions at the same time, silver moves violently. There's another reason silver fluctuates so dramatically, and most people never consider it. The silver market is small, remarkably small. The entire global silver market is estimated to be worth somewhere around $30 billion. The gold market is worth closer to $13 trillion. That is not a small difference. That is a canyon. What this means in practice is straightforward. When a large institutional investor, a hedge fund, a sovereign wealth fund, a major bank, decides to move money into silver, even a relatively modest amount of capital can push the price dramatically. The market simply does not have the depth to absorb large flows without reacting sharply. In a large ocean, a single stone creates barely a ripple. In a small pond, that same stone creates waves that reach every shore. Silver is the small pond. There is a number that experienced investors track quietly, almost obsessively. It is called the gold to silver ratio. It measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 40 and 60. When it rises above 80 or 90, silver is considered deeply undervalued relative to gold. When it falls sharply, silver is caught up, and the gap is closed. This ratio is not just an academic exercise. It is a diagnostic tool. It tells serious observers something important about market sentiment, economic stress, and the relative positioning of two of the world's oldest forms of real money. When young entrepreneurs and business leaders learn to read this number, they gain access to a level of economic intelligence that most people around them will never possess. Silver's volatility is not random noise. It is not panic. It is not irrational behavior. It is structure. It is the natural result of a small market carrying a double identity in an increasingly unstable global economy. And right now, that structure is sending a signal, the kind of signal that serious people cannot afford to ignore. There is an old saying among seasoned market observers: gold is the mirror of fear, silver is the mirror of everything else. Most people hear that, nod slowly, and move on. They do not stop to ask what everything else actually means. But the ones who do stop, The ones who sit with that phrase and pull it apart carefully, those are the ones who begin to see the market in a completely different way. Because silver does not just fluctuate randomly. There's an engine behind every move. There are pistons, valves, pressure points. And once a person understands how that engine works, the chaos starts to look less like chaos and more like a map. The supply side, a foundation built on fragility. Built. Every year, the world produces approximately 800 million ounces of silver. That sounds like a large number, and on the surface, it is. But here's what makes that number dangerous. More than 70% of all silver mined globally is not mined as silver. It is extracted as a byproduct, a secondary output from mines primarily digging for copper, zinc, lead, and gold. Silver comes out almost accidentally. It is collected along the way. What this means is deeply important. When industrial demand for copper or zinc slows down, those mines reduce their operations. And when those mines reduce operations, silver supply drops too. Not because anyone decided silver was less valuable, but because silver was never the main target to begin with. This creates a supply structure that is fragile, unpredictable, difficult to control. And when supply becomes unpredictable in a market this small, prices do not adjust gently. They lurch. Add to this the role of silver recycling. A meaningful portion of annual silver supply comes from recycled materials, old electronics, photography equipment, industrial waste. But recycling flows are inconsistent. They rise and fall based on price incentives and economic conditions. When silver prices drop, recycling becomes less profitable, and supply tightens further. The supply side of silver is not a stable foundation. It is a structure built on sand, and markets built on sand do not absorb shocks well. The demand side, where industry meets investment. If the supply side is fragile, the demand side is volatile. Silver sits at the intersection of two completely different buyer communities, and both communities behave in entirely different ways. The first community is industry. Manufacturers of solar panels require silver for photovoltaic cells. Electric vehicle producers require silver for battery components and electrical systems. Semiconductor manufacturers require silver for circuit boards and conductors. Medical device companies require silver for its antimicrobial properties. These buyers do not purchase silver because they believe in its monetary value. They purchase it because their production lines cannot function without it. And here's the critical point. Industrial demand for silver is growing. The global push toward renewable energy, toward electric transportation, toward advanced electronics, is increasing silver consumption at a rate that many analysts believe the current supply structure cannot sustain indefinitely. The second community is investors, and investors behave nothing like manufacturers. When inflation rises, investors rush into silver. When currency values fall, investors rush into silver. When geopolitical tensions escalate, investors rush into silver. And then, when conditions stabilize, they exit, sometimes quickly, sometimes all at once. Two communities, two completely different motivations, both moving through the same small market simultaneously. The result is amplified volatility. Every time industrial demand surges while investor sentiment shifts, silver does not simply move, it swings. Speculative capital, the accelerant, nobody admits is there. There's a third force operating in the silver market that rarely receives the serious attention it deserves. Speculative capital, hedge funds, commodity traders, algorithmic trading systems that execute thousands of transactions per second based on pre-programmed triggers. These participants do not buy silver because they need it for manufacturing. They do not buy silver because they fear inflation. They buy silver because silver moves, and movement creates opportunity for profit. When speculative capital enters a small market like silver, it does not stabilize prices. It amplifies whatever direction the market is already moving. If silver is rising, speculative buying accelerates the rise. If silver is falling, speculative selling accelerates the fall. This is not conspiracy, this is mechanics. And it explains why silver can gain 8% in a week and lose 6% the following week, without any significant change in the underlying fundamentals. Currency devaluation, the silent engine beneath everything. Behind all of these forces, there's a quieter engine running continuously, currency devaluation. When governments print money, when central banks expand their balance sheets, when the purchasing power of paper currency declines, hard assets become more attractive. Gold benefits, but silver, because of its smaller market and dual identity, tends to benefit more aggressively and more erratically.